Dear viewers, and welcome to Accounting and Finance in the Workplace. We're following the Osborne book and the AET syllabus working in accountancy and finance. In this unit, our objectives are to work out the difference between finance and accounting, the role of accounting in the workplace, and the difference between management and financial accounting, the different accounting roles, and the working environment. The difference between finance and accounting. Accounting is the system of recording and analysing and reporting financial information. It takes place through documents and recording those documents in the books or the ledgers. For example, an invoice is a request for payment that a supplier will send to his customer if they sell goods on credit. Finance involves providing the management of money and funds to the business. For example, a bank loan, crowdfunding is a type of funding where there's a dispersal of investors, so there's a diverse pool of investors. Angel investing, investment from a rich individual or individuals. Dragon's Den is an example of angel investing. Or investment from savings of the owner is another type of investment that is common. Bookkeeping and accounting. Bookkeeping is the act of keeping financial records. So in the past, books would have been kept the accounting records would have been kept in a book. For example, an invoice would have been written into a book, the amount, the supplier, etc., etc. And they're traditionally kept in T accounts with one side called a debit side, which is the left-hand side, and the right-hand side is called the credit side. We're going to come through and we're going to go through and look at T accounts further in the unit and in subsequent units. So I wouldn't worry too much about what they look like at the moment, but if you're interested, you can always look it up on the internet. Accounting takes the process further and analysing and reports information to business and owners and other stakeholders. A stakeholder is someone that has an interest in the business. Examples of stakeholders are customers, for example. Customers have an interest in the business because they want cheaper goods, value goods, goods that have high quality. The community would like services to be provided by certain businesses. For example, a supermarket, they want to provide them with cheap food. Suppliers want you to carry on in business and buy from them. Shareholders, they want profits from the business. A manager would want promotion, as it says in the picture, or they want high salaries. They want they've got various demands which are not always in line with what the business wants, but hopefully the business and the management would be in line for a well-run company. Employers, they would want a high salary, they want to have the chance to become managers one day, and they want security. Management of financial accounting. This is a very simplified definition of what financial and management accounting are, but there's differences, but for now this definition will suffice. Financial accounting takes past events that have already occurred to produce financial statements. Management accounting is about forecasting into the future. Now, obviously, recording and reporting information such as bookkeeping and then reporting it into trial balance and then into financial statements such as income statement and balance sheet. Forecasting is about predicting into the future. It's a type of management accounting. First one is more of a financial accounting, but management may report financial accounts too. Monitoring and control. This is a management accounting scenario where you have a budget or forecast and you compare your actual results with the forecasted results, and then you may vary your tactics, your business tactics and your objectives and aims, and vary those in line with what's happening and your strategies. External audit. External audit is an independent check of your accounts. They're done by a separate company, and the purpose of this is to provide an independent check to the shareholders and to the management board which may not be in touch with the rest of the company, that they're following financial procedures. There's no there's no inefficiency such as fraud, and they check for things like that. They can't check everything, but they provide an overall picture that the policies and procedures are being followed correctly. Internal audit does a similar job as the external audit, but these are for a larger company. And for a larger company, external audit would be required legally. So that is something which is legally required for a larger company, and some smaller companies that are publicly owned. Internal audit is an internal check of your accounts, and it's done by the management board, the board of directors. And the purpose of an internal audit is that in a larger company, the shareholders may not, and the management board may not be in touch with what's happening at the lower level. So what internal audit does, it's not part of the accounting system, but they provide a check to the accountancy system that policies and procedures are being followed. Sometimes reassuringly, sometimes not so reassuringly, and that people are circumventing maybe the policies and procedures or cutting corners. So this is what internal audit checks. These are accounting roles. Accounting roles are specialist roles normally in a larger company. In a smaller company, certain people may do these all or some together. There may be combined roles. Sales order processing. Taking sales order, producing invoices and monitoring receipts. So this could be one person's job. Purchasing. Sending out orders, checking and incoming documents and making payments. That could be another person's job. Cashier. Recording cash income and payments. Someone else's job. Payroll. Obviously, this is quite a specialist role, especially in bit larger companies, calculating and processing salaries. There's a lot of taxes, income tax, NIC. This all has to be done correctly. If someone leaves, there needs to be checked that they're not still going to be carry on being paid, etc. There's a lot of internal checks that need to be done in payroll. So this is quite a specialist role. Costing. Costing is working out the cost of products and services. Inventory control and monitoring and ordering stock. How accountancy supports the business. The sales ledger. The sales ledger is a specialist role. It's also a book in the accounting system. So there's two. It could be either called the book or a role. But here we're talking about the role. So the sales ledger role can advise. So this person who's fulfilling this role can advise sales and marketing. So the sales ledger basically records sales. So they have a book and they write down what's sold and they record the invoices. If it's credit sales or cash sales, they will just record it directly into the book. And they advise sales and marketing whether their sales and marketing tactics are working, for example. Purchase ledger. Purchase ledger can advise the administration department. Oh, you spent too much on photocopying, you spent too much on paper, cut back, etc., etc. Payroll can advise the HR department if the payroll is 70-80% of the overall income, then they may need to advise the HR department to stop recruiting, for example. Costing section can advise the production and operation department. So what the cost of the product is, whether it can be reduced, what other companies' costings are. The costing has a very important role. It's a management accounting role normally. Cashier can advise the sales department, so recording payments. Obviously, if there's a customer that's not paying, then the sales department will need to know this to stop them making sales to this customer. Accounting information should be accurate. There should be no mistakes. Obviously, with any information, if it's full of mistakes, you're not going to be very happy as a manager. Complete. There should be none missing. The same again. If you've got information and it's incomplete, then the manager's not going to be happy. Your line manager's not going to be happy. The shareholders are not going to be happy. Timely, up to date. There's no point of having information if it's out of date. For example, if you need something by the 31st of January and it's given to you on the 5th of January, then there's little point of giving it because it's out of date. Fit for purpose, it must be relevant for the decision that's being made. This is an example of an organisation structure. An organisational structure where this would represent the board of directors. Normally there's a chairman that sits here who liaises with shareholders and is appointed by shareholders, but the whole management board is normally elected by shareholders. External auditor provides an independent check for the shareholders and the board of directors. You've got these represent communication channels or reporting channels. So this person will report to this person. This person will also report to this person. This person would also report to this person, and this represent a team. This will represent a span of control. So this person controls 3 people. This is a management accountant. Below that, they could have other accountants such as sales ledger. They're not actually accountants. They're subsidiary posts to an accountant. So you could have a sales ledger, you could have purchase ledger. You might have a VAT or tax controller, or probably they'll go here. These are accounting roles, and this represents the communication channels and spans of control.